Hi, this is Jeffrey at Graphfinancials. So today we're going to discuss the split up of Alibaba, and we're going to look into the motivations. So as usual, you can move the pink slider to read. You can pause me and read alone. So Mr. Toby Shu said, we are delighted to share that our board has approved the process to start external financing for Alibaba, International Digital Commerce Business Group, exploration of IPO for Kainayo Smart Logistic Group, and execution of IPO for Fresh Shippo. Right. Comprehensive is talking about a comprehensive capital management plan. Okay. And improving shareholders' return through the implementation of a robust capital allocation framework. Okay, what does that mean? Well, you have, let's look at the latest quarterly and year-ended results release from Alibaba, and it's going to become very clear. Okay, you see that those are the quarters. So you have the income from operation that are very different depending on the situation. If you look with me, first column, China Commerce, income from operation for the quarter, 36 billion yuan, over 136 billion of sales. That's a very fat margin. But if you look at international commerce, negative. If you look at a cloud, for example, it's losing money, still improving, but still losing money. You have local consumer service. So international commerce is new, is relatively new. You have digital media losing money, innovation initiatives another losing money. So you have a business which is mature with very cash flow positive, and you have other businesses which are, if you value them on the operating profit at their stage, you're losing a lot of in the valuation. So that makes perfect sense to, why would you finance that with your internally generated cash flows while there's plenty of demand from capital markets for those type of assets? And that's obvious that what he said, the CFO said, it makes perfect sense when you look at those segments. It's totally a reasonable posture. Okay, totally reasonable. Sorry, I don't know why I open again. Okay, now those segments, how are we going to go about? We're going to go about each segment. Okay, valuation the method of valuation will be different depending if it's a mature business or if the business is in its infancy. We have those segments, but we also have a stake inside Ant Group, which is extraordinarily profitable business, a fantastic business. And what we see is that there was a proposal, a share repurchase plan of 7.6% equivalent of its interest at a price that represents a valuation of Ant Group of around 78 billion. During the IPO, it was valued at 250 billion, something like that, US dollars. And the valuation of Ant Group at that point, let me just find out for you, I think it was 2018. Okay, by late January 2017, okay, we're talking 6 years ago, 18, 19, 20, 21, 22. 6 years ago, that was valued at 60 billion. And Ant Group is, we want to cash you out. Companies, they want to do IPO at the right price, and they want to buy you back at a low price. So this valuation level, knowing how much it was valued at IPO and knowing how much it was valued at in 2017, and given the progress of the company since then, I think Alibaba should say, you know what? No, we are happy with our stake. So that's the first thing. Summarizing the segments, the Ant Group stake, and there was an IPO, so we're going to have to handicap that. The net cash balance, okay, and I think that's probably it. So segments, Ant Group, net cash balance. What we need to also figure out is those forward P seem very low. They seem almost wrong for Alibaba, for the whole of Alibaba. Thank you very much. Bye bye.